Welcome to the 3 Edge Week in Review for the week of February 15th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing whether the equity markets, and in particular the U.S. equity markets, are overvalued or not. Before we get to that, let's just take a quick look at what transpired in the global capital markets this week. Equities still reaching or hanging around all-time highs, but interest rates continuing to rise this week. Benchmark U.S. Treasury yields climbed to the highest levels in a year. And this can renew concern that rising borrowing costs and price pressures could derail the economic recovery. At the same time, the Fed did their part to support the markets. Jay Powell testified before the Senate Banking Committee and reiterated that the Fed intends to hold short-term rates very low through 2023 and would keep buying $120 billion of bonds each month until, quote, significant further progress has been made on employment and inflation. And we're still in the corporate earnings season, and those reports actually continue to be quite positive. The latest example was from Applied Materials, which gave an upbeat forecast based on growing orders from chip makers who are rushing to produce more supply. So now let's turn to today's topic, equity market valuations, and the question of whether equities are currently overvalued. But Steve, first I want to harken back to a little over a year ago where you had written a commentary on February 11th, actually, and the commentary was entitled The Next Bear Market. And that was actually written while markets were continuing to reach new highs. However, lo and behold, within 8 days of publishing that paper, the S&P 500 began what became the steepest decline of that index in market history. And the reason I bring that up is that one of the key points in that commentary was that the U.S. markets were overvalued. And now, just a few days ago, you've written a new commentary, slightly different title. This paper is entitled Market Euphoria, How Long Can It Last? And by the way, that paper is available on our website at 3edgeam.com. But once again, one of the key points in that commentary touches once again on valuations. And there is once again a great deal of debate about whether equity markets and U.S. equities in particular are overvalued or not. And, and we know in our industry, people are constantly declaring, either stocks or asset classes to be over or undervalued. So before we get into that question, maybe if you could just spend a minute or two to talk about how investors actually calculate valuations of equities, either individual companies or indices. And so how is that done? And maybe a little bit on what common industry practices.
Well, to estimate the fair value of a company or the stock market as a whole, you need to look at what are the future earnings that are generated way out into over time. And then you discount those back to current dollars because of the time value of money. So to do a proper valuation assessment, you need to forecast two future events. One is how those future earnings will grow over time. And the other is what will the interest rates be out many, many years. So while this is especially tricky when you value an individual company because it's really hard to predict what any individual company will be like 10, 20, 30, 50, 80 years out in the future. It's a lot more reasonable to come up with estimates for an entire stock market because there's a lot of historical data on the stock market. It averages lots of different companies. And what we know is that by analyzing lots of different stock markets and different country indices, we know that sales growth, profit margins, and interest rates mean revert over time. So it allows us to make some very reasonable assumptions. Now, unfortunately, common industry practice doesn't take that approach. They take shortcuts, and the shortcuts can lead to misleading conclusions.
Excellent. So now for the important question. And keeping in mind that valuations are not necessarily so helpful in the very short term, but what is our outlook in terms of U.S. equity markets? Are they overvalued? And I know that, for example, currently some investors would argue that, well, U.S. stocks are fairly valued because earnings and dividend yields of equity markets are generally more favorable than historically low bond yields. So maybe you could just give us your insight there in terms of our opinion, in terms of overvaluation of the equity markets.
So common industry practice is to take current interest rates, current levels of profitability, and then they make shortcuts where they'll take a PE ratio comparing the price to just recent earnings or the earnings of the next quarter, or other kinds of valuation metrics that take shortcuts just using current information. And that can be very misleading because whatever the current interest rate is, whatever the current profitability level is, might have nothing to do with what it's likely to be 10, 20, 40, 80 years out in the future, because we could be at the high end or the short end, the low end of a cycle. So it can be especially dangerous. And like you mentioned, if you just take a dividend yield or you take earnings yield and compare it to the bond market, you think, well, maybe stocks are fairly valued. But without realizing it, someone who would say that is actually implicitly saying that they think those low interest rates will stay low forever. And we build very detailed earnings discount models. And we find that to make them accurate, you need to go beyond 100 years. It's not till you get over 100 years before each incremental year adds very, very little to the net present value of a company or of the stock market. Mm-hmm. So to give you an example, if you take a reasonable projection for earnings growth for the S&P 500 index of US stocks, and you discount that using just today's current rates, which are near all-time record lows, you can argue that the stock market is fairly valued. However, if you make the more reasonable assumption, and to give the benefit of the doubt, will low interest rates stay low for 20 years and then revert back to their long-term mean, the stock market becomes 50% overvalued. I'd like to turn to a chart to show this. This is what we call the S&P 500 market valuation. This goes back to 1900 using this more comprehensive valuation approach. Mm-hmm. And we can see there were 4 times when the stock market was highly overvalued. The first, ironically, was at the last pandemic, the Spanish flu, back in the 1918 to 1920 period. The market peaked in 1919, a year before the pandemic ended, in anticipation of great news in the economy. And then by the time the pandemic actually ended, even though the economy recovered, because it did, interest rates and inflation also went up, and that killed the multiples in the market. And the market, while the economy was recovering at the end of the pandemic, actually fell over 30%. Maybe there's a lesson that we have to take from that. And then other periods, at the end of the Roaring 20s, there was a big overvalued stock market measure. Right after that, we had the crash of 1929. There's a big measure signaling the market was overvalued using this method in March of 2000, right before the tech stock bubble burst. And now today, it's even slightly higher than all those 3 periods. So,
telling. So I think now also it'd be helpful to just describe why valuations are so important in the first place. You know, because there certainly are periods of time, and we're probably living through one now, where people say, well, yes, the market is overvalued, but the market continues to rise. It continues to go up. And so what is it, though, that's so important about valuations in terms of long-term investment success?
Well, you're right. The short-term traders, they don't care about valuation. They're just trying to jump on a trend. But even though valuation has very little to do with how the market moves day to day, week to week, month to month, it is tremendous predictive capability of how well the stock market will return to an investor over the next 10 years. So if we take our same valuation approach, just to show what a great predictor it has been, predicting 10-year returns, we look at chart, we call it expectations of future S&P 500 earnings. And what we're doing here in the blue line, this goes back from World War II to the present. The blue line is our calculation using this valuation approach of what the S&P 500 stock market will return to an investor on average over the next 10 years. And then the orange line shows what actually happened in real life 10 years later after that prediction was made. And we're very pleased. This is not a regression or curve fitting exercise. This is just using fundamental basic valuation approach, how closely the prediction that the model made was to what actually happened 10 years later. And if we follow this through to the end, what we find is that because the market is more overvalued than any time since World War II, we find that the likely return for a stock market investor in the US stock market, this is not true for, say, Japan, which is very fairly valued, but in the US stock market, the likely return is apt to be very, very low. Now, this doesn't mean that the stock market goes flat for the next 10 years. We could still have a market bubble that does a melt up in the next few days or weeks and then bursts. But what we can say is that any appreciation from here is likely to be given up sometime between now and in the future.
Interesting. So we've talked here about valuations of equities, but there are a lot of questions out there from investors that are interested in whether or not bonds are overvalued. So, and maybe even more overvalued than equity. So could you speak to that a bit about the bond market and how overvalued that could be currently?
So this is very important because some people justify investing in stocks now because they compare it to bonds and say, look, compared to bonds, stocks look like a pretty good deal. Dividend yields, as you said, are higher than bond yields, et cetera. Well, we think that's an unhelpful comparison because we think bonds are very overvalued. And so what we think is that when we analyze all the different economic and the valuation and the behavioral forces on the bond market, we see more forces forcing yields up in the near to intermediate term future than forcing down. So we don't think bonds should be doing so well going forward. Bonds generate low interest rates, and there's a potential for capital depreciation as interest rates go up. So as an example, in our total return portfolio, we have a minimum and maximum range that bonds could be at depending on how we feel about them. Say we could be as low as 10%, as high as 80% invested in bonds. Right now, we're at the very bottom of our range, 10%, because we expect rates to go up and that might hurt the value of bonds. Some clients might say, why not go to zero? Why have any drag at all if bond yields go up? And what we say is that in investing, often it pays to be a bit humble and to recognize that nobody has a perfect crystal ball, that events happen in the real world that go against even the best predictions with the best models and the best research. Sometimes things just happen out of the blue that no one could predict. And it is true that if for any unforeseen reason, we find ourselves in a recession that's accompanied by deflation, that's the one environment where you're glad you own at least 10% in bonds because those bonds will help offset losses in the other aspects. So we think it's important to stay diversified. And even if rates do go up, and we were right, and bonds act as somewhat of a drag on a portfolio, well, that's a good problem to have because it means that the other assets we have, like real assets and more fairly valued equities, should do very well and much more than offset the drag in the bonds.
And that's really well said, because one of the things you have to get used to with our strategies is you're always going to have something in the portfolio that actually isn't keeping up, and that's fine. And that's fine. So anyway, great. Very, very helpful discussion about valuations. That will do it for Steve and me. We will be back next week with another edition of our 3Edge Week in Review. Reminder that all of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. And you can always subscribe to our YouTube channel. And if you would like to receive a copy of Steve's latest commentary, Market Euphoria, How Long Can It Last? That is also available on our website. And again, the address is 3edgeam.com. And you can also write to us at WeekInReview@3edge.com and request a copy, and we will send that right out to you. So thanks for listening. And on behalf of everyone here at 3Edge, we urge our listeners to remain safe, to stay strong, keep the faith. Thanks for listening.